From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, inflation data coming in hotter, a dovish chair Powell staying on message, and treasury markets confusing just about everyone. We begin with the big issue, the economy heating up.
You're in the midst of getting hot inflation numbers.
Very hot inflationary CPI number.
A CPI and a PPI print that were just insanely strong.
You're seeing it in retail sales figures.
The pressure is building meaningfully.
Inflation is going to be running hotter.
Move into a position of excess demand.
The demand picture is robust.
We underestimated the level of inflation.
What Chairman Powell has laid out is
this continued rhetoric of, inflation's going to be transitory.
Allow this thing to continue to run as hot as they can for as long as they can.
Letting inflation run too hot.
Is the Fed really in agreement that inflation is going to be transitory?
The Federal Reserve is going to be late to the party.
That starts the debate. Joining us now is Invesco's Noelle Corum, Sankaran of Morgan Stanley, and Mark Cabana of Bank of America. Guys, let's start there with the idea that this Treasury market is confusing just about everybody. Noelle, I want to come to you. We've had hot CPI, we've had hot PPI, we had hot retail sales. I've talked about this every single day of the week. What is going on in this bond market?
Yeah, so as you mentioned, hot CPI, hot retail sales today. We're seeing very little moves from the curve today, seeing some steepening. And it's really just the market not believing the Fed and what the Fed says they're going to do. Powell has been very consistent, but the market is still kind of turning back to those dots and what the dots mean. If you look at where the hikes are actually priced, there's only one priced for 2022 and very little price for 2023. So that tells me that the market thinks the Fed's going to have to go because of hot inflation, but not necessarily hot growth. And we think that growth, the story is not over there. We're going to continue to see the reopening trade. We're still seeing in retail sales. And we just don't think that that story is over. It's just a matter of who's going to win the cat and mouse game between the Fed and the market as over the coming months.
Sri, what's your take?
So our rates colleague sees this way. There's a fair amount of technicals involved here, right? So just like we did see in March on the other direction, so it does feel like there is the element of buying or shorts coming off that's driving some degree of the moves. The initial reaction post the June FOMC, that seemed a little, at least for the day or two, that seemed a little more reasonable. But I guess coming off it, it does feel like there are enough question marks around the persistence of the inflation dynamics. I think that's kind of what seems to be driving this move, where the market seems to be dismissing a lot of these inflation trends, both on the CPI, PPI front and the retail sales numbers, et cetera. It's just a reflection of the reopening dynamic playing out, but nothing to move the debate further on whether this is transitory or persistent.
Your reaction, Mark?
So we do think that there are some technicals at play, but the move in rates has been catalyzed by some fundamentals. And those fundamentals are, one, a very real shift in tone from the Fed around inflation at the June FOMC meeting. Two, questions about the durability of growth and whether we're at peak growth or beyond peak growth. And that has exacerbated underlying positioning in the market. But when we think about what's the real big story here, it's the Fed. And it's a Fed that the market's questioning their commitment to an inflation overshoot and a sustained inflation overshoot. That's what's driving 530s flattening. That's what's pulling in the timing of the first few rate hikes. It's that shift in tone from the Fed. And in order for the Fed to convince the market otherwise, we think that they probably need to get taper out of the way, get that launched so that they can then start talking about the timing of first rate hikes, because the market does see tapering as tightening. And two, they need to see evidence that some of these inflationary pressures are transitory. It sounds like they're a lot less confident in that, or at least they are seeing risks that it may not be as transitory as they originally thought. And as long as there are those questions, then the Fed is going to have a hard time being very dismissive of inflation.
Let's pick up on point one, Mark, if I can jump in on tapering. If they start doing that, Mark, you know what happens next. The sequencing just kicks in. It's a green light to start talking about interest rate hikes, isn't it? How do they avoid that?
That's the challenge for them. And what the market is hearing from them right now is that they are marching to taper, and they indeed are. We think that they're going to make the announcement for taper at the end of this year and then start it in the very early parts of next year, probably start reducing their pace in January. But when the market hears that from the Fed, they think tapering is tightening. And the Fed is going to have a very difficult time convincing the market that that is not the case. That tapering is somewhat about moving away from extraordinarily easy policy. Tapering is somewhat about stabilizing markets and making financing conditions very, very easy. And that tightening or raising rates is actually about sustained inflation and a very tight labor market. The Fed will try and convince the market that tapering is not tightening, but I really think that they just need the tapering headache out of the way before they can then really begin to manage the market's expectations around the timing of the first liftoff and the pace thereafter.
Noelle, what's your response to that?
So I would say that it's all about timing, getting the growth in a good place to where they can say, yes, we're confident that growth is strong here, that inflation is transitory. Tapering announcement, they probably do want to get that announced this year, but don't want to start until Q1 of next year, similar to Mark's view there. But the key is definitely timing and really you being persistent on your consistency from Powell's perspective, and just continuing to say, hey, this is this is our view. We think inflation is transitory, and it makes sense here to wait for the average inflation to kind of pan out around 2%.
Sri, your reaction?
So yeah, I mean, post FOMC, it did feel like the market, the June FOMC, it did feel like the market was kind of coming to the view that the Fed had moved on to how and when rather than if and when of the debate of tapering, right? But the subsequent minutes and obviously Powell's commentary seems to have suggested that the debate hasn't really moved forward as much. So to that extent, it does feel like there are enough question marks around the durability of the inflation dynamics, or even with respect to the labor market, some of the prints around the long-term or the more long-term unemployment rate, et cetera. I think those are still driving some degree of doubts around how quickly the Fed would move. Again, for us, the base case was that it's going to be some kind of a September announcement where they are going to start talking about tapering, and it's only like the early part of next year that they will actually go ahead and taper. But obviously, the range of outcomes around that has increased in the recent weeks.
And here we are at 130 on a US 10-year, some 50 basis points, almost 50 basis points south of where we were at the end of March. And people are asking the question, have we already seen a peak in yields, not just for the year, but for the cycle? Take a listen to what PGIM's Robert Tibb had to say on that.
I think we have seen the peak in rates probably for the cycle. There could be another twin peak later on. But I think that is one of the underpinnings of the long-term decline, secular decline in rates, aging demographics, and high debt burdens.
We may have seen a peak. That's Robert Tibb of PGIM. He's not alone. Steve Major of HSBC alluding to that a little bit earlier this week on TV and radio with me, Lisa, and Tom Keene on Bloomberg Surveillance. And I just wonder, Mark Cabana, your response to that, the idea that here we are, it already feels so early, yet for some people this cycle's moving at light speed, and maybe we've seen a peak in yields and a peak in this yield curve too.
So I'll take the other side of that. We don't think that we have seen the peak quite yet. We do think that we're going to see another twin peak or rates move potentially higher than what we reached in Q1. And the reasons for that is that we believe inflation is truly transitory. It will take some time for the data to prove that out. But as that happens, it's going to allow the Fed to recommit to fate, establish that they do want to see a sustained overshoot on inflation and growth. And we do think that the data will be supportive of that the Fed will be able to generate more upside inflation risk in the market's mind, and also better expectations for growth. Supporting that view is that you have a very resilient consumer. You've got a savings rate that's quite elevated. You're going to, in all likelihood, get more fiscal stimulus that is supportive of growth and productivity. And in that backdrop, we think that you're going to see rates move higher. The trick is, though, that it's probably not going to happen until the Fed can convince the market that they're not going to tighten too soon, choke off the recovery, and choke off any notion of more sustained, longer run inflationary pressures.
Sri, that's a difficult trick to pull off right now. Your thoughts on which side of that trade you'd be on? We've got Steve Major, Robert Tipp, PGIM, HSBC respectively, talking up the potential of a peak in rates already for the cycle. Mark Cabana taking the other side. What side are you on?
So I'll take the side of my rates colleague, Matt Hornbach and team, right? So their forecast is 180 by the end of the year and 2% by the middle of next year. So I do think that it's very early to or premature to say that the levels have peaked for this cycle. Definitely not in that camp.
Final word, Noelle. Just think about it. The argument is as follows. It's an easy one to get your head around. Every single cycle, we add more debt. Every single cycle, our tolerance for higher rates diminishes somewhat, and every single cycle, the peak in rates is lower. Why wouldn't this be it?
But every single cycle, we're also looking at unemployment that's falling, and we're looking at more of a clear picture, an economy that's, at least on the other side of the reopening, and we're just not there yet. We don't think the data is there yet to really support a peak being behind us, and that's why we're still calling for rates to increase here, still calling for a steepener going into year end.
There we go. Now, Mark, Sri, seemingly on the same page on this one. They're going to be sticking with me. Up next on the programme, the auction block. Big banks leading the charge in IG debt issuance as the financials emerge from earnings season. That conversation up next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off right here in the United States with the big banks topping the charts for high-grade debt issuance this week. Morgan Stanley and Bank of America helping to push new issues close to $30 billion. Elsewhere, Delta offering to buy back up to $1 billion of high-cost bonds issued at the height of the pandemic. The three bonds maturing in 2025 and 2026 respectively. And private equity offerings leading a resurgence in US high-yield issuance, with the 5-day total on track to top $6 billion. Let's bring in the team. Noelle Corum, Sankaran and Mark Cabana still with us. And Sri, we spent the last 10-15 minutes talking about rates, yields at 130 on a nominal yield on a 10-year in America. Real yields deeply, deeply negative. We're talking about growth potentially being choked off. And then you look at credit and you wonder if anything's actually happening at all, Sri. What is going on?
Yeah, if there is a growth scare, credit didn't get the memo, right? Because clearly it's been fairly range-bound. So, I mean, the thought process here is that obviously there's a lot more kind of going on in the rates market, but it does feel to us that there is sufficient liquidity across the board, whether you're talking to the investor community, whether you're talking to the issuers, you're talking to banks. There is a fair amount of liquidity surplus, and that's kind of reflected in at least certain portions of the market, seeing the funneling of this cash or liquidity coming in. And that's kind of what's driving this dynamic. And some of the biggest beneficiaries out there are some of the sponsors in the private equity space. As you rightly pointed out, one of the things that we are tracking is the amount of sponsored issuance that's coming in, but more so in the loan space rather than in the high yield bond market. More than 3/4 of issuance in high yield is still refinancing related, so it'll be good to see some net issuance there. It's the loans where it's still the first port of call for a lot of the private equity sponsors, and that's kind of the dynamic that we're watching more closely.
Noelle, the loans market, that's your world. What do you see?
The loans market has seen great demand this year. Returns continue to come in really strong for loans. The reopening is benefiting loans really well. There's still relative value plays relative to high yield, to IG. I wanted to make one comment on the triple C's in high yield, and
Sure.
how, they're just not performing this month like they have, because we're not seeing liquidity in the secondary market. Issuance has been quite robust in high yield, and a lot of the cash is taking profits in triple C's and then moving that to the primary issuance. That's something to keep in mind. That in the high yield spaces, we tend to want to focus or overweight in the higher quality ratings amongst high yield.
Sri, in triple C's, at the bottom end of the credit quality spectrum, as Noelle points out, is that a crack in credit? Anything to be concerned about?
So it's not really cracking, but I completely agree with what Noel mentioned there, right? So there was I would say that the valuations got to an extent where we're a bit more concerned around how complacent investors were around the behavior of the asset class. As we've spoken about, John, before, I mean, the triple C pocket does well as a capital appreciation or a price appreciation trade early in a cycle. at the current level of valuations and prices, it's very difficult to engineer meaningful outperformance in the CCC. So we also kind of transitioned into an up in quality bias within the high yield space, kind of around April and May, and that's probably a bit too early, but we're still sticking with that call. It does make sense to kind of play a bit more of defense at this part of the cycle.
Nothing too dramatic going on here. Mark Cabana, if you're the Federal Reserve, we caught up with the St. Louis Fed President, Jim Bullard, earlier this week. Michael McKee spoke to him and talked to him about tapering, and he said the decision was originally made in the context of an emergency, a crisis, facing the potential of a depression, and we're not there now. Yet he had one concern. We don't want to rock the markets too much. I'm paraphrasing, but that was pretty much it. Mark, when you hear what your colleagues have got to say, what your peers have got to say, the likes of Sri, Noelle, on the credit market, there's nothing to be concerned about here, is there? Get on with it.
Liquidity is abundant, and it's going to get even larger, at least in the couple months ahead. That's due to ongoing Fed QE, and it's also due to the decline of the Treasury's cash balance. There's going to be more cash in the system, and it's going to be about $1 trillion or so by the end of October, assuming no debt limit resolution and Treasury cash balance rebuild after that. So this dynamic of very, very easy financial conditions is likely going to persist, barring some type of significant external shock to growth. And in this context, with incredibly easy financial conditions, it makes a lot of sense, in our view, for the Fed to march down that path to taper. You're right, Jonathan. The way that they arrived at the $120 billion a month of treasuries and mortgages purchases was almost by experiment. They initially needed to do a lot to stabilize the markets, and then they withdrew to the point where they believed that the markets could function well on their own. But is that the right amount for them to be adding into the market today? I don't know. And I think it makes a lot of sense when you think about how easy financial conditions are, how well credit is behaving, for the Fed to think about dialing back. And they're going to do that, and they're likely going to follow market expectations, which have them starting taper in early next year.
I want to build on that, Mark, this question about financial conditions and just whether these financial conditions, this credit market is now just totally divorced from the underlying economy. Now, I asked that question to Margaret Patel of Wells Fargo a little bit earlier today. Just take a listen to what she had to say.
I don't think we have a cycle anymore. I think the Fed determines that we're on a, you might say, a secular path of low growth around a very, very low range of yields.
Sri Sankaran, let me repeat that. I don't think we have a cycle anymore. I think the Fed has determined that we are on a secular path of low growth around a very, very low range of yield. Sri, when you hear that, what are you thinking?
I mean, I see where she's coming from, right? At the end of the day, this has become an environment where, I mean, for the longest time, there is a very protracted period of time where, regardless of what the cycle risks are, there is still the backstop that's provided by the Fed, and that's kind of leading to this thesis that the cycle dynamics, et cetera, are not there anymore. But that would mean that a lot of effort that we put into these cycle indicators or talking about where we are in the cycle, et cetera, would just go to waste. So at least for that reason, I would still like to believe that there is still an element of a cycle. It may play out in a more sporadic fashion. You talk about it as mini cycles rather than a grand credit cycle, so to speak. But it does kind of give you some degree of guidance or guardrails around what is the portion of the cycle that you are in, how do you position your portfolios. And as I mentioned earlier, when we are early in a cycle coming off a recession, et cetera, or the recession risk is priced in lower, that does mean that you do want to play up for these compression themes. I think given where we are now, I think regardless of what you say, whether it's a cycle or not, we would consider this as an environment which is more mid to late cycle, and therefore we want to be a bit more defensive in terms of how we are allocating credit.
Noelle, final word.
I would just say this is exactly why the rates market is so confusing relative to the credit market, because the credit market is looking at fundamentals, and fundamentals are telling us that leverage or defaults are expected to be lower, and company fundamentals are improving, and earnings are so far really robust and expected to be really robust going into the coming weeks. And so it doesn't make sense for the market there to start pricing for what the rates market is telling us. And I'd say that's probably my final word.
Noelle, you can have that as your final word. More still to come. Alongside Mark Cabana is Sri Sankaran. Coming up on the programme, still ahead, the final spread. The week ahead, featuring an ECB rate decision and news conference with the ECB President, Christine Lagarde. That conversation just around the corner. From New York, this is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now to head to the final spread. The week ahead, coming up, featuring Monday, Prime Minister Boris Johnson set to lift COVID restrictions on the UK. We're finally getting there. Tuesday, we get US housing starts, plus, if you care, another billionaire heading to space. On Thursday, the ECB rate decision, along with a news conference from Christine Lagarde. And on Friday, look out for the US and UK PMI data. Some final comments now with Noelle Corum, Sankaran and Mark Cabana. Mark, a lot of ink is going to be wasted on the ECB next week. Let's not do too much of that now. I just wonder from your perspective, when we're talking about tapering, I want to talk about the size of balance sheets. They are huge at these central banks, and they'll remain that way for a long, long time. And we'll be talking about flow and stock. What's going to be important for the next several years?
So you're right. Central bank balance sheets are going to be large, and they're not done growing yet, though the pace of growth will slow. I think that what we're going to focus on in particular is the amount of cash available, the amount of liquidity that's in the banking system. And right now, in the US, certainly, it's too much. And we heard that in bank earnings this past week. We heard that some banks are actually trying to manage the size of their deposits. They don't want additional inflows, and they're trying to push that away to either other banks or to other parts of the Fed's balance sheet, namely the overnight reverse repo facility. And this is going to be the environment that we will be in for a very long time, likely years. You know, the New York Fed asks market participants, when do you think we'll start to shrink our balance sheet?
Yep.
It's not until 2025 or 2026. So this ultra liquid environment isn't going away, even with a reduction in the pace of central bank asset purchases.
We're going to do this for a long, long time. I mentioned the ECB. Let's get to the rapid fire round, and we'll start with the ECB. It's on Thursday. Here's the first question. Do you watch the presser or take an early weekend? Watch the presser, take an early weekend. Noelle, please, you first.
For me, it'll be the presser since I'm in the US.
Sri?
That's the politically right answer. Yes, presser.
Mark Cabana?
If you're in the market, you got to pay attention to the presser. But
I'll be hosting the show. I'll be hosting the show.
They're not going to do that much.
I'll be here. I've got no choice.
A lot of credibility.
Mark Cabana, Sankaran, Noelle Corum. Guys, it's been fantastic to catch up. Appreciate your time. Needed to squeeze that one in ahead of Thursday, an ECB rate decision and full coverage you must watch here on Bloomberg TV. For our audience worldwide, this was Bloomberg Real Yield. This is Bloomberg.